Hi, welcome to StockWatch. I'm Yu Xian, and my team's objective was to fully utilize the capital on hand to maximize yield and to achieve risk reduction through diversification. Our strategy involved employing a top-down analysis of the economy and capital growth strategy approach to investing. Evaluation techniques such as the DCF model and the comparables approach were used to identify mispriced assets and predict future stock movements. That being said, here are the stocks that had the most impact on our portfolio.
The team invested in the technology sector, which is SGX's best performing sector in 2017 to date. With Internet of Things rapidly gaining popularity, it is predicted that by 2022, 18 out of 29 billion of connected devices will be related to IoT. Valuetronics has since taken advantage of the IoT megatrend by entering into the automotive industry in the development of in-car connectivity. This contributed to a promising outlook for the firm, where its ICE segment is forecasted to grow up to 20% in coming years. Its high PE and PB ratios may seem like it's an overpriced investment. However, a leading net income of 27.4 million, coupled with a high ROE and ROA ratios, affirm the firm's ability to demonstrate the strong profitability relative to its price. In anticipation of a greater future gains, the team decided to enter a long position of 82 cents.
With improving GDP rates and labour market conditions, the consumer staple industry is expected to perform better in 2017. The F&B sector in Asia Pacific is likely to exceed global gains by 2020 as diets in emerging markets converge with those in developed nations. Therefore, the team selected Thai Beverage for investment. In line with its vision, Thai Beverage has been actively expanding and building its brand presence into new markets. It is able to leverage on its associates, F&N's high net cash position and debt capacity to further expand into ASEAN region. The team proceeded with a buy decision after deriving a DCF base value of $1.09 per share. We believe that market share gains from its expansion activity will contribute to stronger revenue growth. However, due to the falling momentum and the limited trading timeline, we closed our positions in June, locking in a 2.3% return. To enhance its position in the industry, MM2 entered into collaborations and stake acquisitions in firms such as The Unusual, which contributed greatly to MM2's strong performance in FY 2017. MM2 also expanded its cinema operations aggressively to capitalize on the soaring growth in the Asia-Pacific region. With more people becoming digitally active, MM2 ventured into the online live streaming platform through its partnership, which is believed to be able to generate significant returns for the firm. Although its high PE and PB ratios may raise concerns of share overvaluation, the team believes that it is in the current expansion phase and also reflects the market confidence in the firm's future earnings. However, due to the falling momentum in its share price, the team decided to close the trade during June, locking in a profit of 3%.
Since 2013, Singapore Medical Group has been embarking on a rapid expansion. Recently, the firm has made 2 huge acquisitions to expand into the women insurance healthcare field, leading to its company share price tripling within a year. In addition, SMG has sustained a reputable stakeholder who's investing $15 million on the group. Liquidity and net cash position is expected to improve, and it's believed that the firm will further enhance its portfolio, leading to more potential M&As in the future. Coupled with the positive outlook of the industry, we decided to enter SMG at the price of 57 cents after our DCF model indicating an expected price of 69 cents. Subsequently, SMG share price escalated to a new 52-week high of 69 cents, and we therefore closed our position, locking in a profit of 12%.
The decision to long high-growth stocks such as MM2 and SMG proved to be a wise one. However, the US tech crash on 9 June caused a spillover effect, resulting in heavy losses for the team's technology stocks such as AEM and Valuetronics. Despite this, the disposition effect caused the team to make an irrational decision, where we hesitated to close the loss-making investments. This proved to be a fatal mistake, as the stocks never recovered. Therefore, this resulted in an overall loss position for the portfolio. The team concluded that the proper remedy should be to adhere to the predetermined loss limits and not to submit to behavioural bias. That being said, this loss has since taught the team a valuable lesson by providing a first-hand experience on the significant impact behavioural finance has on portfolio performance. And by that itself is actually a gain for a lifetime. I'm Yu Xian, and that's it for StockWatch. See you next time.